Markets this morning. Stocks looking to rebound in January after the worst monthly beginning to a year ever. I want to bring in Raymond James, Chief Investment Strategist right now. Jeff Saut is with us. Jeff, good to see you.
Pleasure.
Thanks so much for joining us. Exciting morning. So we've seen heavy selling early January, new month, new day. Do you think we're going to see more volatility, more declines in the market, or is the worst behind us?
I think you made a low last Thursday. You had some of the highest odd lot short selling since March of '09. You had 0 IPOs in the month of January. All the earmarks are there. The markets were very oversold. I actually think the economy is stronger than the surface figures suggest. And if you look at the low print we made and believe S&P's bottom-up operating earnings estimate for this year, we were trading at 14.6 times earnings at the low, around the 1800 level.
So you would be putting new money to work in stocks right here?
I would be putting new money to work in stocks right here. I think it's going to be the year of the stock picker. I think John's absolutely right. I think you've got decorrelation. I think people sold their winners last year to free up money because it's going to be a stock picker's year and put money to work in new issues.
What's the argument for stocks? The economy is barely growing. Central banks are running out of room to stimulate it more. China is slowing down. Why would you argue to have money in stocks in this kind of environment?
Because I think stocks, dividend-paying stocks, are inexpensive right here. The only metric I see that shows stocks expensive is the cyclically adjusted PE, the CAPE, and that would have kept you out of stocks for the past 7 years. I don't have much use for an indicator that would have kept you out of 230% rally.
The dividend yield on the Dow and the S&P 500 for stocks is pretty much higher than a 10-year Treasury note. What kind of signal does that send you?
Historically, that meant that stocks were a buy. I mean, even back in '74, you had the dividend yield on a number of stocks above the money market rate. It didn't happen in '82 because the money market rates were at 22%.
Yeah, so that's interesting. Go ahead, Michael.
Yeah, Jeff, you're talking about dividend-paying stocks, obviously important for a lot of your clients. We were just talking about the energy stocks with BP today. MLPs have obviously had a very rough run here, oil in general. Do you see opportunities in that sector? If not, what are the big sectors that you like here in terms of the income stocks?
The midstream and downstream MLPs, they're toll takers. They own the pipes. They're like a transportation company without wheels. And they have longer-term contracts. You can buy an investment-grade portfolio of midstream and downstream MLTs with an aggregate yield of 7.5%.
Wow, that's nice.
And a lot of that is classified as a return of capital, so it's tax-deferred.
You're buying energy company bonds in this environment? They've gotten cream.
I don't have the skill sets to drill through the balance sheets.
The only problem with these dividend-paying stocks is individuals have gotten so burned on them. You want to go back to the bank stocks in 2008, but particularly these energy stocks, because yields are so low on fixed income, people have been pushed by their professional advisors into these energy stocks a year ago, and they've rode them all the way down. So good luck convincing mom or pop, though.
That's a fair point, but they pushed them into upstream master limited partnerships, which have price sensitivity to crude oil. The midstreams don't have that much price sensitivity to crude oil, and the midstreams have been sucked down because of what happened.
I know,
to the
but
upstream.
if they're sucked down, nobody cares what the reason was, whether it was a baby out with the bathwater or they've lost money.
That's why this stuff looks cheap by some metrics. That's when you buy if everyone else is reluctant to do it.
I know, but I'm saying try to convince an individual who's lost money in these things in the last year to double down and to put more cash into them.
If you didn't own them prior to now, you don't have losses.
But that's also why you're supposed to buy. The best time to buy bank stocks was in 2009.
Because it's 14.9 times earnings.
Yeah, that's right.
Yeah, okay. So that is lower than what we saw, obviously.
Right, but a lot of these people were sold these things a year ago. So, you know what? I would have bought bank stocks, but, in the bottom in 2008, too. But people got wiped out. Individuals got wiped out in them, and so they didn't have any more money to invest, is the point.
And that's because they didn't adhere to Benjamin Graham's, the essence of portfolio management is the management of risks, not the management of returns. It's all about managing risk and avoiding the big losses.
So let's talk about some of the risks, because in the Eurozone right now, we had some economic data, and, the unemployment rate in the month of December out this morning in the Eurozone, 10.4%. So you still see a real troubled situation when you look at the fundamental backdrop of Europe, fundamental backdrop of Japan, and yet the central bankers are continuing to put that stimulus in there. Bank of Japan taking rates negative. How does that change things?
I have a hard enough time investing in this country. I don't tend to
So
invest.
you just want to be U.S.?
Yep. Yeah, that's exactly right.
It has to matter to you what's happening in these other countries. They have an effect on the outlook for U.S. stocks. How are Europe, Japan, and China, the three biggest other economic centers in the world, affecting your outlook for the U.S. economy?
I talk to portfolio managers. I have a huge following in Europe and in Asia. And with the strength of the dollar and what's going on up until January with the U.S. markets, money is coming into the U.S. markets.
So you like the U.S. It's interesting. Are you on the other side of that trade, Michael?
No, I like U.S. Just one. I know we have to wrap, but one quick thing. We haven't talked about small caps versus large caps. Small caps getting beat up. Do you see opportunities there?
Russell 2000 getting crushed.
Yeah, that's true. Small caps, I think, are still kind of expensive here. Large caps make more sense to me.
All right, we'll leave it there. Jeff, good to see you.
My pleasure.
Thank you so much for joining us. Jeff Saut from Raymond James. More